Johnson & Johnson, stock ticker J&J, is now trading right at its 52-week low, and over the past year is down about 10%, and in the past month alone, now down close to about 4%. And trading at this level gives the company a starting dividend yield of close to about 3.44%, which actually, if we look at the dividend yield history for this company, one of the things we can see is this is actually the highest starting dividend yield the company has had in the past decade. So in this video, we're going to be talking about what's driving the share price down right now, and it looks like there's two current factors. We're going to be talking about the valuation and the upcoming earnings report. Now, before we jump in any further, I do want to quickly mention Seeking Alpha is getting ready to release their top 10 picks for 2025 on January 8th. There'll be a live stream, and I will be tuning into that, and I'd love to have you join me if you are available. I think it'll be really interesting to see what the Seeking Alpha team has put together. So let's go ahead and dig into it. Now, the first thing that I do want to point out, what attracts most people to the stock is the dividend metrics. This company is a dividend king. If we jump over to my dividend breakdown sheet, let's come up here and plug in J&J. Again, we can see the highest starting dividend yield in a decade, close to 3.4%, a great history of dividend growth, the 5-year dividend CAGR sitting at about 5.5%, and the 10-year sitting close to 6%. So we're seeing dividend metrics that are pretty typical for more mature companies like Johnson & Johnson. And the good news is, as of right now, the payout ratios look healthy. We can see payout ratio as a result of earnings sitting at about 33.5 and free cash flow payout ratio 64.5. And it looks like the free cash flow payout ratio has stayed in a pretty healthy range for the entirety of the past decade. Now, if we take a look at the company's most recent earnings report, here's what we can see. Yes, revenue saw a beat by about $300 million, and earnings was technically a beat if you look at it on a normalized basis, but if you look at it with GAAP accounting principles, they saw a miss by about 58 cents. So there's a pretty big difference here between the GAAP actual and normalized earnings. And really, it just goes to show you why I prefer looking at free cash flow. The free cash flow is not going to lie to you. Now, this company's getting ready to announce their next quarter's earnings on January 22nd, here in a couple weeks. And if we look at the earnings per share revisions over the last 90 days, we only have 1 bullish and 14 bearish. And some of that is because in their most recent earnings report, they actually lowered their earnings guidance moving forward. Now, before we discuss the two factors that I believe are currently pushing the share price down, I do want to make sure we have a proper understanding of Johnson & Johnson's capital allocation priorities. So if we jump over to their investors presentation, if we come over here, we can see the top priorities. To start off, you can see top priority is fueling internal growth opportunities through research and development, and this is almost always going to be the top priority for companies like Johnson & Johnson and Pfizer. And the reason is they're constantly having to grow their pipeline of drugs. For example, if you go over to the Johnson & Johnson website, you're going to be able to see their entire development pipeline, what's on the way, and how far it's come. Because the future revenue growth and earnings growth is almost solely dependent on this. Now, along with this, the company is constantly looking for mergers and acquisitions that could prove to be profitable for the company as well. But after that, they are looking to deliver a competitive dividend and execute share repurchases. So again, capital allocation priority is going to be organic growth. So meaning they're looking for ways to grow free cash flow, and that's by expanding their pipeline through research and development. And we can see that's the highest priority, but they also consider investments in mergers and acquisitions when it makes sense, and then paying out dividends and share repurchases. Now, this is very important to understand because capital allocation is going to let you know how they plan on rewarding you as a shareholder. This is something you should understand for all the companies that you own in your portfolio. Now, when we talk about the factors that are currently pushing the share price down for this company, there's one that's a little bit more on the speculation side, and then a second one that's definitely going to affect the underlying fundamentals. And if we look at the first one, we can see, yes, the healthcare sector is typically known for stability during periods of economic turmoil, but that's not the case as of right now. A lot of investors have concerns over the fact that RFK Jr. will be appointed head of the Department of Health and Human Services. And after this news, the Healthcare Select Sector SPDR fund actually had its worst weekly return in more than 4 years. So this is news that's definitely more on the speculative side, but you can see why this does have some investors concerned. So this news hasn't just affected Johnson & Johnson with their sell-off. We've seen companies like Pfizer, Pepsi, and Coca-Cola. They've all had pretty significant sell-offs over the past month or two because of this news. Now, how that news will actually impact the companies, we don't really have any idea yet. And in reality, it could prove to have no effect at all. But the second driver pushing the share price down, in my opinion, is much more real. And this is something I don't see enough analysts talking about right now. And that's going to be the financial impact from the company's ongoing lawsuits as of right now. Now, what we know about these lawsuits is over the next decade, it's expected to cost them about $10 to $15 billion, and that is a lot of money. But what we can do based off that data is assess the health of Johnson & Johnson's balance sheet and their ability to continue to grow free cash flow moving forward to be able to handle those lawsuits and continue to grow as a company. So if we go ahead and jump over to my balance sheet breakdown, come up here, let's plug in Johnson & Johnson. What we can see is as of the most recent quarter, total assets for Johnson & Johnson sitting at about $178 billion and total debt sitting at about $35.7 billion. So the debt to assets ratio is in a very healthy range, currently sitting at 0.2. And if we zoom in and take a closer look at the balance sheet highlights, we can see cash and cash equivalents at the end of the most recent quarter was sitting close to about $20 billion, and at the end of 2023, it was sitting at about $21.8 billion. And again, keep in mind, total lawsuits are estimated to cost about $10 to $15 billion over the next decade. So as of right now, I do think the balance sheet is poised to be able to handle that blow. So the second question we still have to ask is the earnings and free cash flow still poised to grow as a result of this? Well, if we go ahead and jump back over to Seeking Alpha, let's look at earnings expectations over the next few years. If we come down here and look at the estimates, we can say yes, earnings growth is projected to be slow, but for the majority of these years, we're looking at about 5 to 6% earnings growth. Now, how will this impact free cash flow? Well, if we go ahead and jump over to my free cash flow analysis sheet, come up here and plug in Johnson & Johnson. There's plenty we can look at here, but here's what I really want to point out. If we zoom in, come over here and look at free cash flow conversion. What is this telling us? Well, it's telling us what percentage of earnings is actually becoming free cash flow. And obviously, we want to see the majority of earnings be translated into free cash flow. And Johnson & Johnson over the past decade has actually done a very, very good job of this. So if we're seeing earnings grow at 6% and they have a high free cash flow conversion, we can actually expect free cash flow to grow at that rate as well, or even higher for some of these years where it's above 100%. So the short answer is yes, I do expect free cash flow to continue to grow. So with all that being said, does this current sell-off present a buying opportunity for Johnson & Johnson? And to answer that, we'll go ahead and jump over to my valuation spreadsheet. Come up here and plug in J&J. One of the things we do want to point out is Johnson & Johnson has a very low beta, so this is a good option for people looking for low levels of volatility. There's a lot of people that think that's very attractive. Now, if we look at the discounted cash flow analysis for this company again, assuming just a growth rate of 5.5% for the free cash flow for this company, we could see we come to an intrinsic value of about $160 per share, which is a decent bit above the current trading price. If we look at the dividend discount model, assuming just a 4.5% dividend growth rate, which is a little bit below what they've achieved over the past 5 years, we actually come to an intrinsic value of about $146.60. And if we compare how Johnson & Johnson is currently trading compared to how they've historically traded, look at this. Price to earnings non-GAAP forward looking is sitting at 14.47, while the 5-year average is sitting at 16.55. So all this bearish news seems to make the stock a little bit undervalued compared to how it's historically traded. It's currently about 12.56% cheaper than how it's historically traded. So if we jump over to my output tab, we can see if we average these two valuations together, we do come to an intrinsic value of about $153 per share, which is about 6% higher than the current share price. So with a 10% margin of safety, it looks like we come to an acceptable buy price of about $138 per share. So there's no doubt this is not a high growth company by any means, but this is a company that has low levels of volatility and pays out very predictable dividends, and it's been doing that for over 60 consecutive years. And it looks like the current sell-off has given it a little bit of an undervaluation. Now again, we will need to watch this stock closely to see if the speculation with RFK Jr. becoming the Department of Health and Human Services head has any impact on this company from a fundamental standpoint. But as of right now, it does look like the company is trading slightly below its fair value. So go ahead and let me know what you think of Johnson & Johnson in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.